My next guest sees 2026 as a transitional year for the real estate market, with the focus changing, moving away from the interest rate problem. I want to bring in Fox Business real estate contributor and Mansion Global host Katrina Campins. Katrina, it's always great to see you.
Thanks for having me today.
Yeah, so there's a great piece in the Journal this morning which highlights that Gen Z is increasingly investing their money in the stock market over home ownership as a means to generate wealth. I want to get your reaction to this, because one of the things they talk about with this younger group is that they initially were putting money in the market because they couldn't afford it. Now they're deciding, I'd rather choose the stock market over home ownership because, frankly, the returns are just better. What do you say to that?
Well, I think it's really interesting. I think that it makes sense that Gen Z is leaning into the stock market right now because it's accessible, liquid, and it doesn't require a six-figure down payment. But historically, real estate has been one of the most powerful wealth-building tools in America because it combines appreciation, leveraged, and forced savings. What we're seeing, in my opinion, isn't a rejection of home ownership. It's just a delay. High rates and affordability constraints have pushed Gen Z to park capital in equities while they wait for better entry points. As borrowing conditions ease and incomes rise, I expect many of these same investors to diversify into housing, especially once they recognize that real estate isn't just an investment, it's a hedge against inflation and it's a long-term stability play as well.
Right, in particular because, they're looking at a market that is doing strong. You and I both can say that we've seen markets, the stock market, not do as well, like the housing market. Everything is cyclical. You have some good points, though, about 2024 to 2025. You say that was about rates, but that 2026 is all about affordability and inventory as buyers begin mobilizing again. So is this turning into a true buyer's market? Or do you think that home prices are still a little bit overvalued right now?
Well, I think the last 2 years were dominated by interest rate shock. Buyers were frozen, sellers were locked in, and the transition volume just stalled. But in 2026, it's shaping up to be a normalization year. As rates stabilize and potentially drift lower, affordability improves. At the same time, more inventory is coming online as life events like job changes, relocations, family growth force movement regardless of rate levels. That's the shift. We're moving from a rate-paralyzed market to a supply and demand balance. Buyers are recognizing that negotiating power in many markets, or they have more negotiating power in many markets. And while they're not talking about a price crash by any means, we are seeing more balance, more concessions, and more opportunity. I have seen in the past 3 weeks so much more optimism in the market. And it's really amazing to see. Buyers are landing deals. And even though prices remain high, and it's definitely a bifurcated economy, we are seeing buyers get off the sidelines, right? And on the entry level side, affordability is still tight and the buyers are payment sensitive. But in the luxury and high demand markets, we're seeing resilience driven by cash buyers, equity rich move up buyers, and high income households who have benefited from strong asset markets. These buyers are less rate sensitive and are helping stabilize prices at the top end. So while headline prices remain historically high, underneath that data, we're seeing negotiations increase, seller concessions expand, and selective opportunities. The recovery, though, isn't uniform, it's segmented. And that's why understanding those segments is where real expertise matters.
Yeah, well, I've got a minute left, and I can imagine that the luxury market is obviously immune to what we're seeing with interest rates. But with Kevin Warsh being nominated as the next Fed chair, I want to ask you about the Fed funds rate and how you think it's going to impact housing this year. I mean, there's been some rumblings about a March cut, unlikely, but what are the things that you point to, and I've mentioned this as well, is, forget what the Fed does, watch the 10-year, and you make a great point. You say, if inflation hits 2.4%, it did. We got that number on Friday. You said, that is where you're going to see kind of the shift in a positive way, and that mortgage rates are going to start to go lower before we even see an interest rate cut.
Yes, Cheryl. And the Fed funds rate doesn't directly set mortgage rates, but it strongly influences them through inflation expectations and overall financial conditions. And if the Fed maintains a disciplined, inflation-focused stance while price pressures continue cooling, mortgage rates could gradually ease alongside greater policy clarity. Housing will benefit from both lower rates and, just as importantly, stability in the market. It's that combination, improved affordability and predictability, that gives buyers the confidence to move forward in a transitional year, which is what we're in. And as you mentioned, the latest inflation data showing cooling price pressures combined with a steady labor market is exactly what housing needs. It's exciting. For once, we're finally getting some movement and some momentum.
Right,
and
yeah.
when inflation moderates, mortgage rates tend to follow. And when unemployment remains stable alongside real wage growth, buyers feel secure enough to make long-term financial commitments.
That's the other piece, Katrina, because we've seen wages go higher under President Trump. Real wages were lower for 4 years under Joe Biden. And that is the shift as well. That's the psychological shift, even better. Katrina, it's great to see you. Thank you for being here.
Thanks so much for having me. Happy President's Day.
Oh, yeah. Same to you.